Hi class, Professor Viersen here. I want to do a couple videos that help explain this new concept of using the net method for recording merchandise purchases and sales of merchandise. The first one is kind of a short problem, and it actually establishes two new accounts. The one account is the estimated refund liability. Okay, that's a liability and it goes on the balance sheet. And the other one is an estimated inventory returns. And of course, that is an asset that also goes on the balance sheet. And this is different than the gross method where we use sales returns and allowances. Now we're actually going to use these new accounts to account for when there's a return from the person or the customer who we sold it to. So let's just jump in. It says the Country Carver had sales totaling 14,800 during the month of June. Based on experience, company management expects 7% of the sales amount to be refunded to the customers in the form of sales returns and allowances. Okay, so there's sales returns and allowances that we used to put on the income statement. And of course, now what we're going to do is we're going to put it on the balance sheet in the form of these two new estimate accounts. And then it says the cost of Country Carver of the goods that are estimated to be returned is $625. Okay, so the first one we're going to do a journal entry then for the estimated refunds, and that's for the entire month. And so if we're estimating 14,800, and we're going to get a 7% of those will be returned times 0.07, you can see that our returns will be an estimated $1,036. So we debit the sales returns, or the sales revenue, I'm sorry, and we're going to credit the estimated refund liability, and the amount then will be 1,036, and our credit is 1,036. We can check our answer just to make sure we're correct. Okay, and that's correct. So let me just tell you something. Whenever you do a problem where you have an estimated account, you're going to basically use an idea like a bucket. Okay, you fill up the account, and then each time a customer then brings back a return, you're going to debit this liability, the estimated refund liability, and it's going to start taking out of the bucket. Okay, so on June 30th, we put in the bucket 1,036, and then if a customer then returns something for $200, we take out, or we have a cup and we pour out 200. Another customer comes in and takes out another 100, and so you can see eventually the bucket is almost empty, and then July 31st comes around and you fill the bucket back up again with your estimate. Okay, the second one is even easier because it just says, how are the estimated refund liability and estimated inventory? Oh, it says journalize then this part that says the cost of goods will be $625. Okay, and these are like adjusting entries. They're done at the end of the month. So this is the estimated inventory returns, and then it goes into the cost of goods sold. They give you the amount of 625 and 625. Check our answer. Okay, now the second part of this is just a little bit of conceptual idea. How are the estimated refund liability, estimated inventory returns reflected on their financial statements? Okay, and the answer to this is, first of all, the refund liability is shown as a current liability on the company's classified balance sheet. The inventory returns is a current asset shown on the classified balance sheet. Okay, so you can see that basically two new accounts. We're going to use the estimated refund liability and then the estimated inventory returns to account for when a customer returns merchandise that he's purchased. Now we'll use this idea when we go on to the next problem. So let's just